Well, welcome to today's webinar. As you know, with Blueprint, we like to give a free monthly webinar about all kinds of underwriting topics. I mean, we mainly stick with, of course, income because we're an income solution tool. But I've been in the mortgage business about 31 years, and I'm excited to show what I call, I couldn't put it in the marketing slide here, the almost perfect plan to underwriting. So in this video, I'm going to walk through showing you how over 30 years of doing underwriting and processing loans and training teams is a systematic approach to quality and speed in your underwriting. Now, I'm outside the Detroit, Michigan area. We like to build stuff around here. And when we had the factories and we build cars, when we say the word automobile, or when you say I have a Mustang or I have an F-150, because the Ford plant's just about 20 minutes away and I got family and friends that work there, so I'll use the Ford example. When I say I have an F-150, it's a truck, right? But that truck includes a lot of different pieces. It has, stereo systems built by other people than Ford. It has transmissions built by other people than Ford. It's got seats. And what Ford does is it assembles the vehicle together, and we call it an F-150, but it is a whole bunch of complex systems that work very well together to create a car or a truck. That's how I look at mortgage. When we look at mortgage, people say mortgage, but it is a combination of credit, income, assets, collateral, compliance, laws, real estate, right? All kinds of different people, title, just keep it on going. So you got to have a system to work through everything. So I like to use the word manufacturing process when you're talking about processing or underwriting a loan. And it doesn't matter if you're a loan officer, processor, underwriter, auditor. This is kind of a, I'm going to give you a workflow that I've created over many years that was trained to me back in the 90s when I started underwriting. And I've been training since 2000 to underwriters. And even this day, we do classes like this. So the reason you want to do this is, loans require competent expertise and knowledge of how it all fits together. I'm going to give you a nice overview of it. But when you're building up your own team or system, you have to get to be expertise in tearing apart every one of these steps and learning to make each step better based on your game plan and your company brand. Now, creating a system review file is key to quality and production. As an underwriting manager, watching underwriters, I knew that if they didn't have a system of how to do things every day, they kind of jumped around files and they forget to check this or check the income or check the credit score. Now, look, I'm a little ADD, like I kind of get distracted very easily. So I'm talking about myself here. I had to have a checklist to get myself through a file. And creating a system of daily work habits is a key to customer service. So using the same system, we're talking about how to get through a file, but also having attached to this how you handle things. How do I notice people that will get loan approval? What's the process when a loan comes in? What's required when a loan comes in? What's required when the underwriter approves of the close? What's required when you're ready to close? Things like that. Now not going to cover that today, but I just want to show you like the way you assemble your mortgage system is really important. It is your secret sauce, your personality of your customer's journey and how you want to go through it. So let me just share with you for a few minutes about the way I look through underwriting and processing, and that's what our focus our webinar is today. Okay, here's the picture of the roadmap. We're going to talk about each steps, but I like to think about the way I process or underwrite files. Start in one space, go around, complete the loan, all the steps, and then I get back here. Guess what? I restart my review again. As an underwriter, I don't just do one file a week or something like that, right? I do multiple files a day. I do resubmissions, new loans, audits, whatever I'm doing. So this is my little racetrack roadmap about what we're going to show you. Now let's break down each step quickly and give you an idea of what would be covered in step 1 through 10. Now, the first thing, which is the most important, whether you're again setting up a file or underwriting a file, is read the story, step 1. Now, in the underwriting world, the transmittal summary will help you frame the story. And the story is this a purchase or a refi? Is this an FHA or a conforming loan? Do I have a second home, two borrowers? What am I doing? The 1008 will give you most of that. Now, the application will tell you the story about the borrower you're reviewing. So if I read an application as underwriter and I say, oh, you're self-employed, in future steps, I would expect to see tax returns, bank statements for the business, things like that, or whatever's required for that self-employment. If you're employed and you switch jobs, I might expect to see different W-2s for the last 2 years that I may or may not have to blend together. But this is the thing about having the story straight in your head. So first of all, what kind of loan they're doing, have the guidelines straight in your head, what's required, so that as you're reviewing, you're properly applying the right story to your borrower. I mean, don't be putting FHA guidelines on a conforming borrower, right? Now, again, it's really important that the guidelines will help guide you if your client can get the requested loan. Now, you're going to see in the way I get these steps set up, Steps 1 through 5 are basically kind of a go, no go point. Once you get past step 5, the loan should be able to be approved in theory, right? Now there might be conditions that hold you back. But when we cross from step 5 to 6, which we'll go over in a little bit, it's kind of like your borrower can get a loan or can't get a loan. And there's your borrower could get a loan, but the property falls through or it doesn't qualify. That's where the break even. We'll talk about that. But the first 5 steps are going to vet out pretty much if this person can get a loan or not based on the story or the narrative or the type of product that you're trying to put in there. So that's step 1. Now that I've read the application, I know what guidelines I'm using, I know what program I'm doing as an underwriter, I'm ready to start reviewing more about the borrower. So, my first step is look at the credit report. Again, this is kind of a big make it or break it. If I get a borrower with a 520 FICO score, I'm pretty sure I'm not going to be able to approve this loan. But I do still have to complete the process. But we want to kind of get our mind straight about, kind of qualify, don't, no go, no go at this point. Now, credit points aren't just the credit score. That's definitely an important thing to show you. They also give you some other information to validate the application. Like you might see, we all know it has current and past debts. We'll talk about that in the next step. But there could be public records on there. If you have a bankruptcy 2 years ago, you can't get a loan anywhere. Or maybe they got a bankruptcy 5 years ago and it was submitted as a conforming loan. You can't do a conforming loan, but you could do a government-based loan. Also on here in the application or in the credit report, you'll see like addresses. So if I look at your app and I see that you said you've lived at your current home for 8 years, but your credit report shows like 5 different addresses, it's a red flag. Nothing means absolutes. It's just indicators of things you start paying attention to. Where you work, where you live is on the credit report. It'll say, your last employment known or whatever. Doesn't mean it's accurate because remember, a credit is a repository, so it collects things. You put things in it. When you apply for credit cards or loans, it goes, oh, what's your name? What's your social security number? What's your birthday? Where do you live? Because you applied. They don't go out like try to gather it from you. And uh, judgments go on there, the courts go on there, credit providers go on there. So it's a repository of information. So, if you haven't called or applied for a loan and you moved 2 years ago, it won't be updated. So it's just informational, right? All that in there. Last thing is name changes. Now, this is more, probably toward the female side of things where people get married and their last name changes. And, it might alert you to divorce decree or something. I mean, obviously, it's normal that people get married and change their last name. So, again, just informational. So, credit report score is important, but there is other information you should be paying attention to from a quality control standpoint. Now, while I'm on the credit report, even though I divided this in step 2 and 3, I have a different focus when I'm doing each step. Or while I'm doing the credit report review, I have to think about, the credit report as a credit document and the credit report as a debt document, like what debts are available. So, of course, when you're looking through in step 3, you want to start looking at the debts you have and validate them against your application. Now, debts can be deferred, which would create a different rule set. Revolving debts have different rules than installment debts. Student loans have different rules than regular installment debts. Paying off debt to qualify may or may not be possible. Debts paid by others depends on what program you're talking about. So as we're going through the application and we're doing our 1003 review and I'm making sure that all the payments are listed and oh, look at that. That car payment has 8 payments left. Did I count it or did I not count it, my DTI? Oh, there's a student loan. Now I got to go to the guidelines and find the Plinko game that you have to play depending on which agency we're talking about what do I do with that student loan. So it's a little more difficult than it looks, but that's what I do in step 3 is I get my debts lined up and review. Now, the fourth step is income. Now, Blueprint Income Expert, of course, that's what we do. We do income analysis. So if, in all the training of underwriters I've done, the most like under the steps, if I said there was, lessons under each step, there might be one or two under most of them. But income has like 30 plus different trainings that we do. Self-employment, liquidity, grossing up. I mean, variable income, changing jobs, VA disability, all kinds of things, right? And so it's one of the most complex steps there is. I used to think it was appraisals before CU and those kind of things come around, and before we standardized the appraisals back in 2010 or 11, and use the upload through the agencies to kind of better vet the information out. It used to be kind of like appraisals were a little harder income because there's a bit of artwork to them, but now by far income is definitely the most difficult. Now, there also a little side note here. You often hear underwriters say the four C's. Some people say five C's. I've never agreed with that thought because the other one is character, the fifth C. I don't think you can judge people's character by credit report or things like that. But what I'm looking for would be, credit, capacity, and capacity is debt and income combined. What's your DTI? So credit, capacity, collateral, what are we securing for the mortgage, and capital, where's your money coming from? So this step three and step four work together in a DTI kind of set. Now, the number one reason for buybacks or errors after close is DTI issues, right? Now, when you look at the charts from ACEs or whatever, you can't really break down, is it an income miscalculation or was it a debt miss? I would guess, and this is just an educated guess, 90% of it is income miscalculation. And then 10% of it is like you probably did the student loan wrong, or you didn't notice a debt, or you tried to, not count a lease payment because it was under 10 payments or something like that. So, again, important steps to all put together. All right, so step four, income. Now we move on to assets. Now, assets, pretty straightforward. Cash for reserves, cash for close, or that's what you're gonna be looking at. And so you got your cash for close, which is your down payment and your costs and your escrows, cash for reserves, which means after you close, you have to have so much money left in the bank to qualify, which is more typical on an investment property or non-QM lending or something like that. Most conforming loans that are primary residence don't require a reserve component. They're easier to, there's an easier criteria when you live there versus, say, an investment property. Now we're in the set, we got to think about, what category we need the money for, and then we got to think about what type of money we're being presented. There's several forms of liquid and non-liquid accounts, and it can be you can't use you can't use a checking account for assets as income, right? But you could use it for reserves, as part of your reserve statement. So you got to again know the difference between liquid and non-liquid accounts. And I just kind of keep it simple as an underwriter. If I can call up or get the money pretty much without asking for a loan or asking a third party and just say, hey, go to my bank, I need 10 grand out of my checking savings, whatever, my CD, where there's no permission, no loan process, no requirements needed, that's liquid, right? Non-liquid is, hey, I've got an option on my stock and it's not 4 years old yet, or I want money out of my 401k. You can't just go write a check out of it. You got to call your employer. You might already have a loan. You can't get it, or an IRA or something like that, right? So that's what non-liquid, liquid accounts go. So in this place, I review, the assets and looking for large deposits in the bank statements, but mainly focusing on what type of money that they have. Now, this is where we go the break over or the kind of go no go step. Once you get to step six, now we focus on the property. So you should never get a borrower to this step. If they can't pass steps 1 through 5, why are we paying for an appraisal? Why do we have realtors running around showing homes when they can't pass steps 1 through 5? This is how you're going to burn a referral base, right? So it's really key that, when you first talking to people, you really don't want them having a home yet. I mean, if they do, fine. A lot of them obviously will. They have good credit. They bought houses before. They kind of know where they're at. But, from a really kind of like procedural step, there's a little bit of risk if you show up and kind of go pick the house out before you have the money lined up. You always want to have the money lined up before you go buy the asset, right? I mean, I may want a Ferrari, but I shouldn't show up at the Ferrari dealership with no idea how to pay for it or what it's going to cost me. That's the thing about that there. So now in this step, what am I reviewing? I'm reviewing the appraisal or value documents. I'm looking at title, homeowners insurance requirements, HOAs, condo requirements, flood determination requirements. Everything that's really nothing to do with, I say it's more to do with the property than the borrower. Everything here is more about the collateral or the 4C collateral than it is about the borrower. And that's what I mean again about the breakover point. If you can pass the first 5 steps and the house doesn't work out for whatever reason, repairs, doesn't qualify, too big, too small, it's got a nuclear dump site behind it, whatever the problem is, you're going to have to decline the borrower, but not because of them, because of the property. And so what you're going to do is then, let them go find a new property. But like I said, you can't get step through 1 through 5. You can't pick any property out. Now, step 7, this is my miscellaneous review step. Now, people always, when I first was teaching this class, like, oh, you just were trying to round it to 10, so you made up a miscellaneous step. No, there's actually a very useful point about miscellaneous. This is where you stop and take a pause because you've pretty much done the whole work of the loan. The borrower's approved, the four C's are good. I've looked at the collateral, things be looking good. Now there might be additional procedures you got to stop and do. Condo review department may need to be notified. If I'm a junior underwriter, I might need a second signature before I can move any forward. If I'm doing a jumbo loan, I may need to send my appraisal to the investor to get looked at. Or if I'm doing a non-QM loan, they may want to look at the bank statements to figure out the income. That's, the kind of like we'll call that the company procedure steps. Then you got things that kind of are out of or looking at letter of explanations. Like there might be LOEs or LOXs, however you want to call them, that didn't make any sense a few minutes ago, but make sense now since you reviewed everything. So you can kind of look at them and go, yeah, I do or don't need that, or maybe I need a condition for that. Now, I forgot to mention this earlier in the steps, but as I'm going through each step, I'm probably making some notes of conditions. Missing a pay stub. What's this large deposit? Is this a town? Is this a detached condo or an attached condo, right? I could be having things like that I need to condition out in a few more steps. Another thing that's probably going to become more prevalent in 2025 and future is subordination agreements. Now, if you've been in the business a short while, you probably haven't seen these for a little bit because the rates were so low in 21 and 22 and stuff. But when somebody's got like a low rate, like one of my properties has a 2.75, I am never refinancing that thing. It's an investment property too, by the way. I lived there and was able to get a low rate and moved out, when I got married, but I've got this property still, really low rate. Well, I've got a lot of equity in it, but I'm going to take a second lien out on it before I go refinancing that first mortgage. So subordination agreements are a good spot here. And maybe you need to order a second mortgage. Maybe the person did a 80-15, right? Where they got an 80% first, a 15% second, and is going to put down 5% cash. And then just any other document seems out of place. Sometimes I think as an underwriter, I would fall into this, and maybe you're doing it, I'm not sure, where I got a little distracted by what was sent in. And instead of going through my steps and go, okay, there's a pay stub, don't look at that yet. Start with the credit, look at the assets, or there's an LOE about something, or a divorce decree I want to look at. Just go through the steps. And then by the time you get to the step, you'll go, oh, that's not a problem. Yeah, I don't need that information, or I do need that information. But until you have the story straight in your head and you validate it all in your mind, that letter, those documents may seem out of place, but they're going to make a lot more sense once you reviewed everything, right? You'll be aware of the situation. I'll put it that way. All right, step 8, fraud tools. Now, I'm going to stress here that fraud review is done at every step of the process. So if you're looking at a pay stub and things seem off, or bank balances look like they're cut and pasted, I don't hope people aren't doing that thing in this today's day and age, but it's possible, right? Fraud is money's involved. There might be some fraud. We're always looking for it. So when I say the fraud tool steps, I'm not saying ignore fraud except for the step, but you're always kind of keeping an eye out for fraudulent things. Address is not lined up. Maybe you're self-employed trying to hide it, whatever. But this is a spot where you use your tools, like your data verifies, to do what I call a free second underwrite. So it's kind of like, hey, I saw this stuff when I went through, data verify that, I ran it through. I see you say, oh, they've got two properties that they didn't tell you about. Wait a minute, I didn't see any mortgages or anything about that. But, if they got a paid off piece of land that just has taxes on it, no insurance or any debt, maybe you have some vacant property that you have a camp around or something away from your house. Well, there's a debt to it because you have taxes and we have to include that in there. So it might tell you about things you were not able to detect, or there's no way you could have detected. So it gives you a really nice second set of eyes. I call it the second, virtual underwrite. Now, then of course in here, there should be company policies at your company about how you pass these fraud checks. When I worked at a regional bank, 10 so or a little bit longer, about 15 years ago, I remember I think it was a data verify, but they had like two tachometers or speedometers, and they both had to be in the green for me to pass. One was about the borrower, one was about the property. So if they were yellow, it meant there was things that were of concern that I had not addressed. It'd say, hey, this person looks like they have a property. Did you validate that is theirs? Oh yeah, that's actually their parents. They're a junior and this is not theirs. Clear, save, and it would make the little speedometer go up to a green. Once I had green, I could do clear to close. Now I'm not saying I'd be that elaborate, but you should definitely have a fraud tool system in your place. Now, step 9. Now that we've kind of done a really good review, now we can actually talk to the underwriter. Now, you can probably, I'm not sure you can agree with me on this step or not. The underwriter is DE or LP in most cases, right? Unless you're doing a full manual underwrite, because we don't really make the decision. The system makes the decision. Can you override it? Sure. In some cases, very rarely can you do it. I mean, you generally don't want to do it. It becomes a real problem, but we want to submit to the underwriting system. Now, just like anybody else, if you're underwriting, you want a good processor to set everything up, figure things up, make sure the accurate, right? Well, the AUS needs the same thing. Now, the AUS is a computer. It just reacts to what you do. So if it's all goofed up, it's not going to know. It's just going to react to what you did. Now, the AUS is actually underwriting, and you want to make sure that you've put the right bank in there, the right income, the right property, the right LTV. Why submit it until you've done all that? It's just a waste of time and money. Yeah, I don't want 9D runs when I'm going through the loan. So I wait to this step that I've gotten all my concerns. I'm ready to basically go, hey, this file's set up. Everything looks good. I'm ready for an underwriting review from the AUS. Now, the thing about the AOS 2 is you got to abide by what it says. It gives you conditions. And also, you got to be aware of what the AUS does not know, right? It's a computer. It can't, pick everything up. It doesn't think. It doesn't feel. What do you mean by not know? Hey, you submitted that this person's a teacher in Michigan, where I live, and they're buying a primary residence in Florida, and they're 64 years old. It's going to prove them saying, well, hey, you said they make 6 grand a month as a teacher. They've been doing it for 25 years, and there's a primary residence in Florida. Fantastic. Um, but you didn't tell the rest of the story. Oh, she's told me she's retiring in 3 months. Well, now that income is not valid. So even though the AUS may have approved it, it's your fault for not kind of like reading outside the lines a little bit, right? So the AUS does do the work, but you are responsible to work hand in hand with the AUS, giving it context and the thing that only human beings can do, which is probably observe things in a more holistic standpoint. Systems can't do that kind of thing. That's why, as an underwriter, I think our job's safe for a few more years anyway. AI and stuff coming up, who knows? But I'm just saying at the moment, we definitely are needed for that risk review. Our mind is needed for that, not the math and the flood checking and things like that. Now, the last step is the update conditions and loan status. Now, this one seems pretty simple, makes sense. Well, Mike, why are you covering it? Well, here's what I've noticed in here is that this is where, again, written procedures about what to do, how to communicate to people. Hey, your loan's approved, your loan's declined, your loan's ready to go, that kind of thing. I worked at a company a few years back that every time I approved a loan, I had to email the loan officer directly because they didn't have an automated system or give a call. Hey, this is Mike with XXX company, your underwriter. I looked through the Smith file. It's really good. I got one question about the change of jobs, but this is what I'm going to need. Go ahead and check the conditions. But any questions, here's my phone number, right? Or whatever you're going to do. I'm just saying that you should have some kind of communication system set up. More than likely, it'd be automated in today's systems, obviously, but just make sure you've really vetted that out. Now, the condition, a quick note about that. I see a lot of, I'll say underwriters, because they generally write conditions, not processors, don't write the condition properly. They're like, provide pay stub. Okay, I did provide a pay stub. Well, it was 64 days old before app. Okay. You just get a bunch of email back and forth. Like, what do you need that for? I gave you a pay stub. Look, write your conditions out properly. Not, don't write a book, but the format I would use is who, what, why. Who needs to get me something? What is it I need? And why do I need it? Example, uh, borrower to provide updated pay stub within 30 days of application to validate income, right? So what did I gave you who, what, why in that statement? Who, the borrower needs to get it, right? Through the loan officer, or you can say the loan officer needs to get it, whatever you want to say. It's not the underwriter, it's not the closer, it's somebody in the front end. What? I need a pay stub dated within this date. Why? To qualify the income because I need a pay stub within 30 days or less of the application to do the app or a bank statement. Need additional bank statement, borrower to provide second month bank statement of Wells Fargo showing reserves, 40 grand in reserves, right? That's what will stop when I'm on the other end of that, approval letter that comes out or conditional approval. I'm not guessing what you want, and I'm not going to badger the client 15 times to get the right thing. Let's communicate clearly and properly. And that's it. We're done with step 10. Now, last little thing here before we wrap up the webinar for today. Remember, I just went around the racetrack. This works on new purchase deals, like our first time reviews, purchase or refi, first reviews, and resubmissions. The difference on a resubmission is this. When I get in the file, I want to, go step one, check the credit. Don't just jump into step three, kind of breeze through it. It'll be easier, right? It'll be easier because you've already started the file. So these steps will go faster. I don't need anything credit to review. Because when I pick it up, they read the story. Now I'm reading the 1003, the 1008, and my conditions. What did I ask for? So as I'm going through it, I go, oh yeah, I asked for that pay stub because it was out of date. I asked for that bank statement because they were short on reserves. Then I know, okay, I don't need anything in step two. I do need the thing in, don't need anything in step three. I need the pay stub in step four. I need the asset in step five. The appraisal was good. Miscellaneous good. Fraud review is good. Let me rerun it through the AUS. Hopefully give you a clear close, right? And the goal is, this is what I always shoot for, tell underwriters is a good standard. Three or less submissions. Your initial, get the stuff that's missing, final. And if you're really, really good, the initial, the final, right? The initial should be so good you can do it in a final, but understand it would take some time. If you're getting six, seven, eight, nine submissions, something is very inefficient in your system, right? I'm just going to say it outright. You got to get better than that. We have to be more effective. You can do it in three. I think three is a good number. Submit the loan. You're not going to have appraisal yet. You may not have all the bank statements, but you can do most of the four C's, and then get the underwriter to tell you exactly what you need to wrap it up. Get everything you need at once and submit it. Or the better thing is get steps one through five, all your credit, income, asset kind of things in, and only missing the appraisal or the property or the purchase agreement, whatever. And then it comes back, and when you get your first set of conditions, get anything you're missing in, the four C's, and send in that appraisal and or condo or whatever you need to do it and get that closing. But that's a good target to go for great customer service in the mortgage business. All right, hope that helps. Again, Blueprint Solutions, income expert. Glad we could provide this little walkthrough. I've enjoyed teaching underwriters for many years, and this system has worked great. That was taught to me, and I've taught to hundreds of other underwriters on how to get through a file. Have a great day. Thanks for coming to today's webinar.